Are safe withdrawal rates for retirees dropping? New research from Morningstar states retirees will be able to withdraw less from their portfolios moving forward. Are they right? Is there a cause for concern here? We're going to explore this and more in today's video. First, let's define this word safe withdrawal rate. What do we mean here? A safe withdrawal rate is generally defined as the initial amount that you can take from your portfolio and have confidence that this is a very safe amount, unlikely to lead you to running out of money. I would argue the 4% rule is the initial quote-unquote safe withdrawal rate. The 4% rule was found by a financial advisor in the mid-90s. He ran a study that looked at 30-year rolling periods that would signify retirement and invested in a balanced portfolio of stocks and bonds. The study was run in a way where it backtested historical 30-year periods and found out how much someone could afford to withdraw each year from their portfolio. As you can see on the screen, in favorable market environments, you might be able to withdraw upwards of 8%. The worst case scenario was 1966. Here you could only afford to start out withdrawing 4%. Then you would take that dollar amount and adjust that each year for inflation. And you would have just made it to the end of that 30-year retirement without failure. So this 4% was defined as a safe withdrawal rate because it's the worst case scenario, thereby ensuring success in every other 30-year environment if you would follow this 4% guideline. Just as a note, today's safe withdrawal rate is a bit more ambiguous, as some define safe withdrawal rate as having higher than 90% probability of success. Now, if you've watched some of our content in the past, you may have seen me find issue with the idea behind the 4% rule and this type of thinking. Looking just at how much you can take from your portfolio forgets other income streams like Social Security. It leaves out spending adjustments like real spending falling as you age. But although safe withdrawal rate has its flaws, it can still be a solid rule of thumb. Well, at the end of each year, Morningstar releases a white paper titled State of Retirement Income. Now, this is a great paper that has some really interesting ideas on how certain dynamic income strategies or Social Security filing strategies can help retirees spend more. As part of this annual update, Morningstar also releases an update to what they believe the most up-to-date safe withdrawal rate is. With the latest edition, Morningstar lowered this number from 4% to 3.7%. The lower the safe withdrawal rate, it would be assumed the tougher the future will look for retirees. Morningstar is a reputable research firm that puts out some really great content. Is this a cause for concern? Well, let's take a look at the history of Morningstar's State of Retirement Income reports and take a look at how this guidance changes year to year. As you can see from the chart, Morningstar's guidance changes quite a bit year to year. The lowest safe withdrawal rate came in 2021 at 3.3%, and 2 years later it was back up to 4% at the end of 2023. This seems like a lot of volatility for something that should be considered safe and conservative. As a counterpoint, in the traditional way safe withdrawal rate is defined as a worst case scenario, this is a number that hasn't changed since 1966. Given this, one might have some skepticism about why Morningstar's forward-looking safe withdrawal rate changes so much when a hindsight-looking safe withdrawal rate rarely ever changes. Let's talk about what's happening behind the scenes here. Morningstar is taking a set of assumptions like expected returns, volatility, inflation, and more. Then they are taking these assumptions and running a statistical process called a Monte Carlo analysis. This involves randomizing variables around those assumptions to attempt to simulate future potential trials. The idea here being, if we ran our retirement 1,000 times, what would the result be? Based on this Monte Carlo, they found the safe withdrawal rate to be 3.7% with 90% certainty. Why only use 90% certainty instead of 95 or 100% certainty? Remember in a Monte Carlo that we are randomizing variables. For this reason, generally speaking, you leave out some extremes and outliers in your analysis. For instance, in the worst trial of that 1,000 simulation sequence, there might have been a scenario where randomized return variables led to 25 of those 30 years having negative market returns. Although theoretically possible, this probably doesn't accurately reflect what a financial market will do over a 30-year period of time. So this type of extreme is left out. The same would happen with extreme trials to the upside. Now, I have zero doubt that Morningstar's Monte Carlo and conclusion were right. They are great at running really solid analyses. Where I have a problem is in the assumptions used, mainly the return assumptions here. There are two elements to asset class assumptions. You have expected return, which is kind of like a base or average return. Then you have a standard deviation, which is basically the volatility you expect around that return. A high standard deviation will lead to a wide dispersion of returns. Stocks, for instance, have a higher standard deviation because they can be up 30% in one year and down 30% the next. Bonds then have lower standard deviations. Let's take this chart now and compare it to historical assumptions since 1972 for US stock assets. If we compare Morningstar's assumptions to historical returns, we see some big gaps between these two figures. Large cap stocks have averaged around 11% with 15 to 17% volatility. Morningstar believes forward returns on this asset class will be closer to 7 or 8% with even higher volatility. The same may be said for small caps as well. If you lower the returns even further, guess what? The safe withdrawal rate would also drop. Raise these returns and voila, the safe withdrawal rate rises. So really the safe withdrawal rate is not about the analysis, it's about the assumptions being used here. So what's my personal issue with this paper and the lowering of a safe withdrawal rate? It's based on the idea that we can reliably forecast future returns over a 30-year period. And a lot of data shows us, unfortunately, this isn't possible. At the end of each previous year, banks and financial firms around the world will analyze all of the data at their disposal, run in-depth models, and offer a forecast on where the market will end up at year end. Time and time again, these expert predictions are about as accurate as non-expert predictions, or even picking a number out of a hat. On the screen, I have the last 2 years of predictions, and it's amazing how frequently the experts are completely off. Anytime the experts are right, it's more often a broken clock being right twice a day type of thing. This isn't a recent trend, but one that's been going on for decades. Over the past 25 years, forecaster predictions have been within the same ballpark of the actual results maybe 2 or 3 times. Not only that, expert opinions vary quite widely, often seeing gaps of 15% or more from high to low end targets. But giving the benefit of the doubt, maybe this is an issue with short-term predictions versus long-term predictions. Well, let's take a look at longer-term predictions. Many of you might be familiar with an economic model called CAPE ratio. CAPE stands for cyclically adjusted price to earnings. This is a ratio that is meant to indicate whether the stock market is, as a whole, overvalued or undervalued. When CAPE is low, it means PE ratios have been low for a period of time and indicate higher future returns are more likely. When CAPE is high, it indicates lower future returns or even a market crash is likely. Historically speaking, this is a valuation model that has done an incredible job at showing under and overvalued levels in the stock market. It's one that many forecasters cite to inform their models and future return targets. Although this is a model that's been quite effective prior to the 80s, since then, it's been a pretty bad predictor. It just so happens it was also developed or discovered in the late 80s as well. In CAPE ratio terms, the market has looked to be overvalued basically permanently since the end of the 1980s. As you can see, outside of a few months in the 08-09 timeframe, we've been well above historical averages. Yet throughout this time, the US stock market has grown 10.5% per year, which is more or less right in line with historical averages. The point here is even long-term models that have historically been really reliable have done a poor job forecasting returns accurately. And this makes sense. If someone had an incredibly predictive model, they wouldn't need to publish research. They would have a key to basically infinite wealth. So my main issue with this idea that safe withdrawal rates are going to decline is based on the premise that we can accurately forecast returns. And furthering this problem, there are a lot of takeaways that one would have if they believe they have a predictive model for future lower returns. For instance, Morningstar cites in this paper the highest safe withdrawal rates were achieved from more conservative allocations with only 20 to maybe as much as 50% stock allocations. This stock exposure is quite below the best historical allocations. Other key findings were around withdrawal amounts going down if one files early for Social Security at 62. Now, most of you know that I'm a proponent of delaying Social Security for most people. But I'm also quite honest that this is a very contextual conversation. There are times when taking Social Security early can make more sense. If market returns are good enough, taking Social Security at 62 can end up with more wealth through retirement. But in this paper, filing at 62 looks obviously bad because of lower assumed returns. This is problematic as it leaves out important context. Strategies that incorporate guaranteed income like annuities also look like better options than maybe they should in a historical context because of those lower assumptions as well. I think this is problematic and leaves readers with a conclusion that is based on reliably forecasting returns, which I don't believe anyone has the ability to do. Now, this might seem like I'm stepping on my own toes here. If assumptions are so important to planning, and I believe so much in planning, how do I make heads or tails of the contradiction? Well, it's not actually the contradiction it appears to be. If we can't reliably forecast future returns, I think it is best to use historical returns unless we have a real systemic reason why historical returns are no longer informative. For example, if the US changed from a more free market to one that is closed and incredibly regulated, I would agree that we are in probably a new world here. But this isn't at all the case. Given this, using historical parameters and a Monte Carlo will still give you plenty of bad trials to analyze. For instance, when running in Monte Carlo on historical parameters, you will often see trials worse than the worst historical trial. The randomizing in Monte Carlo is already enough. If you were to lower returns too much, you might have something like 35% of trials that are worse than the worst case historically. That is a big prediction and a big forecast, and big claims require big proof of evidence. So to wrap this up, I wouldn't worry or pay too much attention to the annual update of safe withdrawal rates going up or going down. By definition, the true safe withdrawal rate is conservative in nature, and conservative assumptions shouldn't change that regularly. If they do, they probably weren't that conservative in the first place. Thanks so much for watching today. If you want to learn more about how much you can truly spend from your portfolio when factoring in things like Social Security income and other strategies, click on this video right here. And always remember, you don't need more money, you need a better plan. Look forward to seeing you in the next video.